So usually when we think about, building a massive, powerful engine, the mental image is always about giant, heavy components. You picture huge pistons, dense steel.
Right, heavy machinery.
Yeah.
Lots of physical weight.
Exactly. There is this physical logic that massive outputs require massive, heavy inputs. But, well, then you look at the mechanics of compound interest, and that physical logic is just totally inverted. We're looking at a financial engine where tiny, almost invisible inputs, just, a few dollars consistently applied, somehow generate this roaring, massive machine over time.
It completely defies our natural intuition. I mean, human brains just aren't wired to comprehend exponential growth easily. We think in straight lines, but
Yeah.
compound interest is a curve that starts flat and then violently accelerates upward.
Yeah, and for a young soldier navigating the military's blended retirement system, or the BRS, those tiny inputs are quite literally the difference between returning to civilian life with nothing and, well, retiring with an absolute fortress of a financial foundation. So, welcome to the deep dive. We are looking at an official Department of Defense guide to the BRS today, along with some really fascinating behavioral economics data from FedSmith.
Right, the Fed-Smith piece is crucial because it shows how people actually behave,
Yeah.
not just how the math works.
Exactly. And our mission today is really to demystify all this jargon. We want to show you how early decisions can build that massive foundation. Because the core tension jumping out of these sources is wild. The DoD essentially hands service members a high performance financial engine right at the starting line. The math is flawless on paper, but human behavior constantly throws a wrench into the gears.
Oh, absolutely. That collision between perfect mathematical models and messy human emotion, that's where most financial plans just fall apart entirely.
Okay, let's unpack this because we're talking about a young soldier making just a couple $1,000s a month, realistically retiring with hundreds of thousands in the bank, right? But to understand why people sabotage themselves, we first have to look at the architecture of the BRS itself.
Yeah, we have to contrast it with the old system. For decades, the military operated on a purely legacy system, which was an all-or-nothing pension. You
Yeah.
served 20 years, you received a monthly pension for life. You served 19 years and 11 months.
To get zero.
You walked away with zero retirement savings from the government. None.
Which, I mean, that creates an incredible retention tool, obviously. But it also leaves a massive portion of veterans totally out in the cold because, the vast majority of people who join the military do not stay for a full 20-year career. They do 4 years, maybe 8, and then move on.
Right. And the DoD recognized that reality, which is why the BRS was implemented. Now, the traditional pension, what they call the defined benefit, is still there. If you stay 20 years, you still get a monthly check for life. But the calculation changed slightly. The BRS uses a 2.0% multiplier.
Okay, break that down for me.
Sure. You take 2.0%, multiply by your years of service, and then multiply that by the average of your highest 36 months of basic pay. So a 20-year career yields a base pension of 40% of your highest 3-year average. And that comes with a cost of living adjustment to combat inflation.
So the old system was a pure safety net that only caught you if you stayed 20 years. But the BRS is like having a slightly smaller safety net plus an engine you have to learn to build and maintain yourself.
Exactly. That's the perfect way to look at it because the real shift, that engine you mentioned, is the defined contribution side. The Thrift Savings Plan, or TSP. Under the BRS, troops are automatically enrolled into a 401k style system from day one.
And it's not just an empty account, right? They don't just open it and leave you hanging.
No, no. The military automatically directs 3% of their basic pay into an age-appropriate life cycle fund, or an L fund.
Let's talk about the mechanics of that L fund, because it sounds like a generic mutual fund, but it's doing something very specific under the hood.
Yeah, it's really clever.
Yeah.
A life cycle fund is essentially an auto-rebalancing portfolio on a glide path. So when a soldier is young, say in their early 20s, the fund is heavily weighted toward aggressive stocks companies with high growth potential, but also high volatility.
Because if the market crashes when you're 22, you have decades to recover.
Precisely. The logic is that you have time. But as that specific soldier gets older and gets closer to retirement age, the fund automatically slowly shifts its underlying assets. It moves money out of those volatile stocks and into hyper-safe government bonds. It gradually reduces risk, so by the time you need the money, a sudden market crash won't wipe out your retirement.
Wow. So it takes the steering wheel away from the driver? You don't have to actively decide when to sell stocks and buy bonds. The algorithm just does it based on your target retirement date.
Yes. And the critical factor here is portability. If a soldier does a 4-year contract and decides the military just isn't for them, They don't lose that engine. They roll that TST balance into a civilian IRA or, their next employer's 401k.
Right, they leave with actual capital. But, okay, to build that capital, we have to look at how the BRS handles contributions. And this is where the math gets incredibly aggressive in favor of the service member.
It really does.
I mean, I'm looking at the DoD numbers, and I have to be honest, I was a little skeptical of how this works in practice. The guide uses a baseline basic pay of $2,000 a month. That's standard starting pay for a young enlisted soldier. Telling an 18-year-old to aggressively save for retirement when they are barely making enough to cover a car payment, phone bill, and trips home, it feels like a massive stretch. Can a young soldier really build wealth on basic pay without starving in the present?
They absolutely can, because the system leverages government matching to drastically amplify small sacrifices. Let's run the exact mechanics on that $2,000 basic pay. If that soldier decides to contribute just 5% of their pay to the TSP, we are talking about exactly $100 a month.
$100. Okay, that's like a few energy drinks, maybe a couple of skip takeout meals. It's noticeable, but it's not going to bankrupt them.
Right, it's doable. Now look at what the DoD does with that. First, after 60 days of service, the government provides an automatic 1% contribution. They deposit $20 into that TSP, regardless of whether the soldier is contributing anything themselves.
Just free money.
Just free money. But when the soldier reaches their 25th month of service, the matching kicks into high gear. The government will match the soldier's contributions up to an additional 4%.
Wait, okay, let me do the math here. So the soldier puts in their 5%, which is $100. The DoD puts in the 1% automatic plus the 4% match. That equals another 5% or another $100.
You got it. The soldier's $100 out-of-pocket contribution instantly becomes $200 deposited into the investment account. That is an immediate, guaranteed 100% return on investment before a single share of stock is even purchased.
That's insane.
You cannot find a guaranteed geometric return like that anywhere in the civilian financial sector.
But what happens when we project that $200 a month out over a career? Because honestly, $200 still sounds like a relatively small part for an engine.
This is where the time value of money and compounding come into play. It isn't just 200 plus 200. The money buys shares, those shares generate returns, and those returns buy more shares. Over the first 5 years, the growth curve looks pretty flat. But over a 25-year period, assuming standard historical market returns within those lifecycle funds, the $200 a month compounds into almost $200,000.
$200,000, generated from an initial monthly sacrifice of just $100. So the earnings eventually just completely dwarf the actual out-of-pocket contributions.
The math is relentless. It just works. But there's a mechanical catch regarding who actually owns that money in the short term. The vesting rules.
Vesting. Vesting always trips people up. It basically means ownership, right?
Yeah.
When is the money legally yours to walk away with?
Exactly. You are always immediately vested in your own contributions. If you put that $100 in, it's yours. You are also immediately vested in the DoD's matching funds.
So if I put in my 5%, get the 4% match, and then separate from the military the next month, I take all of that?
You take it all. But that 1% automatic contribution, the free money they start giving you at 60 days, has a 2-year cliff. You are not fully vested in that 1% until you complete 2 full years of service. If you leave at year 1 and 11 months, the government claws back that 1% and any earnings it generated.
Okay, so 2 years is the threshold to fully own the entire machine. We've mapped out the perfect scenario, right? Put in 5%, get the match, let the algorithm rebalance the L fund, and retire with hundreds of thousands of dollars. But earlier you brought up human emotion, and this is where the behavioral economics data from FedSmith becomes so crucial, because perfect math only works if you don't touch the machine.
Right, and people love to touch the machine. The stock market is essentially a real-time graph of human fear and greed. The FedSmith data uses the market volatility of 2020 as a prime case study.
Right.
You had massive economic uncertainty, global lockdowns, a sudden market crash, and then an unprecedented rapid recovery.
It was the ultimate stress test for an investor's psychology.
Exactly. And the single biggest mistake federal employees made during that period was emotional trading.
I want to dig into the actual mechanism of why we do this, because it's not just people being foolish, right? It's biological.
It is entirely biological. It's a concept called loss aversion. Psychologically, humans experience the pain of losing money about twice as intensely as the joy of gaining that exact same amount.
Because evolutionarily, losing a resource meant starvation, whereas finding extra resources just meant you were slightly more comfortable. Our brains are hardwired to treat a dropping number on a screen like a physical threat.
Yes. So when these troops and federal employees logged into their TSP accounts in early 2020 and saw their balances plummeting, that fight-or-flight response just completely took over. The data shows mass movements of capital out of the stock-based funds and into the G fund.
And the G fund is government securities. It's essentially U.S. Treasury bonds, right?
Right. It is arguably the safest investment on the planet. The principal is guaranteed not to lose value. But the catch is that its growth rate is incredibly slow, often barely keeping pace with inflation. So by moving their money to the G fund during a crash, these investors stopped the bleeding, but they locked in their losses.
They sold at the absolute bottom. And because they were hiding in the safety of the G fund, they completely missed the subsequent recovery.
The market shot back up, but their money was sitting on the sidelines earning fractions of a percent. That psychological desire for immediate safety completely destroyed their long-term compounding curve.
Which leads to the inverse of that behavior.
Yeah.
If fear drives people into the G fund, greed drives them into the S fund. The FedSmith article highlights the danger of chasing what they call trailing indicators. Walk me through the mechanics of a trailing indicator, because this seems like the trap everyone falls into when a specific sector gets hot.
Yeah, a trailing indicator is simply looking at past performance and assuming it dictates future results. The S fund is the small cap stock fund. It tracks smaller, highly volatile companies. In 2020, the S fund had a massive meteoric rise in value. People saw the staggering annual return numbers. Maybe they heard a coworker bragging about it, and they wanted in.
But by the time those return numbers are published and people are talking about them at work, the growth has already happened. The shares are now incredibly expensive to buy.
Exactly. You are buying at the absolute peak of the market. And what inevitably happens with highly volatile small cap stocks, they correct. They drop in value. So the employees who chase those returns watch their portfolios take a massive hit shortly after buying in.
It makes me think of that analogy from The Source is Right. It's exactly like driving around the Beltway in a major city during rush hour. You're in a lane that isn't moving, and you see the far left lane zooming by. So you aggressively cut across 3 lanes of traffic to get there.
We've all done it.
Right. But by the time you actually get into the left lane, somebody up ahead hits their brakes, your new lane stops completely, and the lane you just left starts moving again. If you keep darting back and forth, taking random exits because you think they might be an optimal shortcut, you just end up driving in circles and never reaching your destination.
That's a perfect analogy. Constant tactical adjustments destroy long-term strategy. This is why financial advisors constantly preach about dollar-cost averaging. You invest the exact same amount of money every single month, regardless of whether the market is up or down. When the market crashes, your $200 buys more shares at a discount. When the market is high, it buys fewer shares. Over decades, it smooths out the volatility and removes the fight-or-flight emotion from the equation entirely.
Okay, before we move on to the later stages of a military career, we really need to touch on the tax mechanics of these accounts. The DoD sources heavily emphasize utilizing the Roth TSP option, particularly for young troops. Now, I understand the basic difference. Traditional TSP is tax-free going in, but tax coming out, while Roth is taxed now, but tax-free in retirement. But why is the Roth such a critical tool specifically for a young enlisted service member?
Because taxes are entirely about brackets. When a service member is young and at the lower enlisted ranks, their taxable basic pay is very, very low. A massive portion of military compensation comes in the form of tax-free housing and food allowances.
Right, so their actual reported income to the IRS is tiny.
Exactly. It puts them in one of the lowest tax brackets they will likely ever be in for the rest of their lives.
So they are paying a historically minimal percentage on that money today.
Right. So if they choose the Roth option, they pay that tiny tax rate now. Fast forward 40 years, they are retiring. They might have a civilian career salary, a military pension, Social Security, and this massive TSP balance. If that TSP was traditional, pulling money out would add to their taxable income, potentially pushing them into a massive tax bracket. But because it's a Roth, they can withdraw hundreds of thousands of dollars of compounded growth, and the IRS cannot touch a single penny of it.
Paying a few dollars in taxes today to shield hundreds of thousands of dollars from taxes later. I mean, it's a no-brainer.
Absolutely.
Okay, so let's look at the mid-career landscape. The blended retirement system introduces a major financial crossroads that requires that exact same emotional discipline we just talked about. Continuation pay.
Yes. Continuation pay is the military's mid-career retention tool. Under the legacy system, if you hit 10 years, the prevailing wisdom was that you were over the hump and financially locked in to finish the 20. The BRS changes that dynamic, so the DoD uses continuation pay to incentivize talent to stay. Between your 8th and 12th year of service, you become eligible for a significant one-time payout.
Let's run the numbers on this. How significant is this payout?
For active duty personnel, the DoD guidelines establish a multiplier range. The payout can be anywhere from 2.5 times up to 13 times your monthly basic pay.
Wow.
Yeah. The specific multiplier depends on your branch of service and the critical manning needs of your specific career field at that moment.
Even at the absolute floor of that range, 2.5 times a mid-career monthly salary, that is a sudden massive injection of liquidity into a checking account.
Well,
And the catch is simply a commitment to serve additional time.
generally, it requires an agreement to serve at least 3 more years, but the real crossroads is what the service member does with that capital.
Right, because in E6, suddenly seeing $10,000 or $15,000 hit their button account is going to feel an immense temptation toward lifestyle inflation. You upgrade the car, you buy a boat, you take an extravagant vacation.
Which is pure consumption. But if a service member takes that continuation pay and immediately injects it into their TSP, staying mindful of the IRS annual contribution limits, of course, they fundamentally alter their financial trajectory. Because that lump sum now has another 10 to 20 years to compound before they even hit retirement age.
It essentially functions as a time machine, accelerating their wealth generation by years.
Exactly. It supercharges that TSP compounding curve.
But it requires the discipline to look at a massive pile of cash and say, I'm not going to touch this for 2 decades. Which brings us to the ultimate milestone. What happens when they finally hit retirement? They finish their 20 years, they've built their TSP, navigated the continuation pay, and they are standing at the finish line ready to collect their defined benefit pension. Under the old system, you just signed the paperwork and waited for the monthly deposits. But under the BRS, they face the lump sum decision.
Yeah, and the mechanics of this are heavily debated. It is the single most complex decision in the BRS framework.
Right.
At retirement, a service member can elect to receive either 25% or 50% of their discounted future retirement payments up front as a lump sum.
Okay, here's where it gets really interesting.
Yeah.
We're talking strictly about the guaranteed pension here, not the TSP balance. You can take a massive chunk of your lifetime pension up front. What is the actual mathematical trade-off?
If you elect the 25% lump sum, your monthly pension check is reduced by 25%. If you take the 50% option, your monthly check is cut in half, and that severe reduction stays in place until you reach full Social Security retirement age, which is currently 67 for most people.
Hold on. If someone retires from the military at age 38, their guaranteed monthly income is slashed in half for almost 30 years.
Yes. At age 67, the pension automatically reverts back to the full 100% payout. But for those 3 decades in between, you are operating on significantly less guaranteed income.
Okay, but if I'm taking a 50% cut to my checks, I expect the lump sum to equal exactly half of the cumulative value of those missed payments. But the DoD guide says the lump sum is discounted. What does that actually mean under the hood?
That is the crucial mechanism people misunderstand. You do not get a dollar-for-dollar advance. The DoD applies a discount rate to that lump sum based on the time value of money. The fundamental rule of finance is that a dollar today is worth more than a dollar tomorrow, because a dollar today can be invested and earn interest.
So the DoD is essentially saying, if we give you this massive pile of money today, you have the opportunity to invest it and grow it. Therefore, we are going to pay you less total raw dollars than if we slowly dripped it out to you over 30 years.
Precisely. They use a published discount rate to calculate the present value of those future payments. Historically, taking the lump sum means you are locking in a mathematical loss in terms of total lifetime dollars received, assuming you live a normal lifespan.
Which means taking the lump sum just to have cash in the bank to spend on a depreciating asset like a car or a boat is a catastrophic financial error. Are you investing it, paying off debt, or just spending it? You are taking a mathematically discounted payout just to fund a lifestyle.
Exactly. The only scenario where the lump sum makes mathematical sense is if you have a rigid, ironclad strategy to deploy that capital. Are you taking the 50% lump sum to instantly wipe out high-interest credit card debt that is costing you 22% a year? Are you using it as capital to launch a business that will generate far more revenue than the missing half of your pension?
It forces the retiree to act like a chief financial officer. You can't just operate on autopilot anymore. The BRS demands active participation. You have to max out the 5% match early on. You have to ignore the fight or flight response when the market crashes and avoid chasing those trailing indicators when the market is hot.
Right. You have to navigate the tax implications of the Roth, and you have to run the actual present value math on your pension when you retire.
It demands an entirely new level of financial literacy. The legacy pension was passive, it required survival. The blended retirement system requires strategy. So, to summarize our deep dive today, the BRS gives soldiers incredible tools to build wealth on a basic salary, provided they max out that 5% match, rely on the math of compounding, and avoid the emotional trap of checking their balances and chasing the market.
And this connects directly to anyone listening, really.
Yeah.
Whether you are military or civilian, mastering the boring, repetitive, long-term strategy of dollar-cost averaging is the absolute best thing you can do for your future self.
Build the engine, fuel it consistently regardless of the emotional headlines, and let the algorithm do the heavy lifting over decades. But, it makes you step back and look at the broader impact of this massive shift by the Department of Defense. We spend so much time analyzing the spreadsheets, the multipliers, and the discount rates, but maybe there's a hidden, unquantifiable benefit to the BRS that isn't printed in the official guides.
What do you mean?
Well, by dismantling the old passive pension system where troops just waited 20 years to be taken care of, the DoD is forcing hundreds of thousands of young people to become active investors. They are forced to learn about compound interest, life cycle auto rebalancing, and the psychological traps of loss aversion. So, what if the greatest long-term value of the blended retirement system isn't just the final balance in a TSP account? What if the real value is the lifelong financial literacy and emotional resilience it forces a generation to develop? You aren't just building a retirement account, you are constructing a mindset. And that's something to think about. Take care of your engine, and it will take care of you.